Thanks for watching. This is James Robertson with WorkSpace. We're going to do a quick analysis of 13111 Westheimer. Now, the purposes of this analysis is for a lease renewal. So I want you to understand what the market is doing here and where this building has been traditionally, so we can project what we need to go for as far as a renewal rate. Now, the rental history here has been $14 a foot forever, literally forever. When we look at the market, I'm going to quickly go to the analysis page here with the charts. So it's now when we look at this particular market and the deliverables, this is the construction that's projected. As you can see here, construction in the broader market here was quite high in perspective. 3.5 million square feet of new office building was projected to be built in 2015. It dropped off precipitously at 2016 and 2017. What this points out is that everybody knows, the banking institutions, the developers know that the demand has dropped quite a bit. So in order to keep the property rent rates stable, they drop construction, or they drop the production of new properties. So you can see here, there's almost zero projected new construction. I count all this as basically nothing. So everyone counts for this being flat. When we look at, we call this a tenant stack, but these are the tenants at the building that we have on record. So it looks like we have 3 lease renewals that are going to be coming up in addition to our client here. So it looks like there's a pretty substantial amount of square footage that's going to come on the market. So we're going to be the first one out the gates to finish a negotiation deal. So I think we're going to set the tone, and our goal is to be as aggressive as possible. But you can see here that LaGrasta Incorporated, it's a real estate company, lease expiring in June of this year. March is going to be MBCO Engineering, and then Crockett & Sons is going to expire in November of 2019. Okay, so we're going to wrap things up by looking at the vacancy rate, the gross rent over years here, and the absorption. Now, vacancy rate was as high as 40% in 2015. And if I remember, we got the deal done, I think maybe 2013 or 2014 here. But we can see that the occupancy has gone up substantially from about 40% vacancy or 60% occupied all the way down to maybe this is probably about 80% full. That's very good for this building. If these numbers are correct and they're still at a stable rental rate, that tells me there's not a lot of confidence in new tenants coming in. They want to hold on to what they have. That's a very good sign for renewal. We can look at the rental rate here and see how it's been steady since 2013. Also, a very good sign that the landlord just wants stability. He just wants to hold on to what he has. He's not trying to drive potential competition to have you leave the space. So I don't think we have to leverage him as hard as we would some other types of landlords. And I think our strategy here should be to go for a bated rent. I think the rental rates, because it's been so stable here, there's not a lot of room to drop rates down because their operating costs are going to be close to $11 or $12 a foot for a building this size. That means that there's not a lot of meat on the bone here. So I think what we should do is take advantage of the stable rate and the landlord's desire to keep tenants and go for a lot of abated rent for a 10-year deal. I want to push for about 6 months of free rent for this particular property. I think that'd be a win. That including the tenant improvement dollars so that we can get the build out that you need if you need any improvements. I think those 2 factors with a flexible lease is going to be a big win for us. So if you have any questions, just give me a call and we can talk about this building or any other ones that you want to. Thank you for watching.